Hey guys, David Robinson here. Welcome to the apartment investing journey. Excited about our episode today. I've got someone on board that has a unique background in the military and transitioning into multifamily real estate investing. And I'm excited to learn more about him and his story. Ray, welcome to the show.
My pleasure. Glad to be here. Thanks for the invite.
Of course. A little bit about Ray. Rey Reyes has been actively investing in residential real estate since 2005 and has focused exclusively on multifamily investing since 2016, becoming a full-time investor in 2019. He has led MI Real Estate in investing in 5 multifamily properties in Alabama, Florida, and Tennessee, totaling 292 units, valued at over $17 million. He's also raised over $800,000 in capital in 2019. And Ray also provides independent consulting to real estate investors and has authored numerous multifamily investing articles. And prior to becoming a full-time real estate investor, Ray served over 28 years in the United States Army, retiring as a lieutenant colonel. So thank you for your service, Ray.
Thank you. It was an honor.
So, Ray, that's just the synopsis of your world. We want to get the entire story. So if you can, back us up. Talk to us about how you ever even started thinking about getting into real estate in 2005 and walk us forward through your process.
Absolutely. So real estate was kind of in my blood from when I was young. I was the guy that, or the kid really, who enjoyed playing Monopoly as kind of like the favorite game, and really kind of, it hit me very quickly how you win the game, and then you try to transfer that to real life. Of course, it's one thing to play a game; it's another thing to kind of translate that into what you want to do for a living. But I think the turning point for me is, after I had a chance to be in the military for a little bit, and I'd actually gotten to a point where I'd had a chance to settle, because when you first start in the military, they move you around quite a bit, so it's kind of hard to even know where you're going to be. And in addition to that, depending on where you get started. Now, I got started as an E1, so the lowest rank that you could be in the military. That's just kind of where I started. So it took me a while to kind of get my bearings and get settled. But by 2005, I'd already gone to school. I had a bachelor's degree. I had already gotten my commission in the military, because I'd always had this urging to serve as well. So it was something that I wanted to do from young, and so getting through that period, I found myself in a place where, okay, this was a good time right around 2005 where I can buy a property, and it's not just a property for me to live in, but a property to invest in. So a little bit different. And so that kind of started my journey. I was actually in San Antonio at the time when I bought my first investment property. It was basically a single family house with a trailer on the property, about 3/4 of an acre. And so to me, that was kind of like, okay, it's not just a single family, but it's a little bit of it's a duplex, and you can get maximize a little bit of the income. So that's kind of how I started in single family. And then if I jump all the way forward, I acquired some properties. I did a couple of other things along the way, including fixing and flipping a property. It was just something that I wanted to see how that process was, and working through that. And I actually even, lent my money to a hard money lender. So I was actually lending money along the way. So I kind of tasted a lot of different things along the way, but it kind of hit me right around the time that I kind of made the move to multifamily in 2016. And I was actually towards the tail end of my career at that point. Like, if I'm going to do this full time, I need to do it so that I can actually get to where I want to go faster. I mean, you can do it single family. There are ways to get there, but it's a slow walk. And so, while you accumulate equity and this sort of thing. And so to me, it made sense at that point in my life to make the jump, at least to look at the multifamily space. And then I went from there.
That's great. That's great. So let me back you up just a little bit to 2005. You're actively serving in the military, you start to think, what got you to start to think about, hey, let me try to find a property that also has the potential to generate a little bit of income? Was there anything in particular that started pushing your mind down that path?
Yes, I mean there were so along the way, there is no real education that you can get in college, to talk to you about how to do financing and how to really invest in real estate, from a personal finance perspective, if you will. But I read some very good books that really kind of started putting it in perspective, and it allowed you to kind of put your head in your mindset in a place where you could see visually. I'm a visual person, so I had to kind of see the numbers and see how it worked, to see that whenever you're able to kind of maximize the income that you receive, and you do that, through having additional units, if you will, and then while still being able to sort of sustain or kind of reduce some of the expenses, you're able to kind of grow that and make a little bit more money, get a little bit more return, if you will. At that point, it was important that I stayed in the single family space because, I didn't know anything about multifamily, but as a single family entity, which is anything 4 units and below, you were able to get some better financing on those properties. So to me, that was kind of where I started. But I mean, Rich Dad, Poor Dad, the books that a lot of people read that really kind of get your head and help you get your head right.
Yeah. Okay, cool. So you really house hacked this very first deal in San Antonio. Was it in San Antonio that you bought that property and the house with the trailer on it?
It was
Okay.
in San Antonio, and so it's an interesting story, that one, because it's not a happy ending, if you will.
Let's hear it.
So, what the bottom line is, you start doing your due diligence. You never know what's going to come up. But the property that was supposed to be two properties in one, I ended up having to revert to a single property because when there was a sewage backup, and it had basically I'm trying to think of the name. It wasn't water sewer from the city, but it was well water and what is the name of that?
Irrigation water.
It was basically where you have the dirty water, the sewage, if you will. It goes into kind of a repository.
Oh, gotcha. Okay.
And so that got full. And the name will come to me, but that got full, and then we went to fix it and repair it. The city had actually made a change with regards to how you can do these sewage, these drainage facilities, if you will. And so we ended up not being able to use the space where we had the trailer anymore because we had to get a different type of irrigation on that property. So just a little thing, sort of threw off, the way you sort of look at these investments. Now, it was not a completely bad story because we were able to keep that property. In fact, I sold that maybe 3 years ago, and just with the single family cottage that it had on it, it basically supported the mortgage on that for the most part. There were a couple of years where it's a little bit under, a little bit over, but over time it was gaining equity. Through just basically the area appreciating at a regular rate. It wasn't anything over the top, but if it just kept appreciating 2-3% a year, while keeping the expenses really the same over that time, and it rented very well. And so it wasn't exactly the way I planned it, and it never really is, but just having some leverage and being able to kind of think through that and continue through that process. And so here I am.
Yeah. So I misunderstood then. So I was thinking that you had bought the primary residence, the cottage, for yourself and were going to rent out the trailer, but you were living in another single family home, another living situation, and you bought this specifically to rent out both units, it sounds like. Yeah.
So this was purely an investment.
Gotcha. Okay.
I bought some homes where I live in them, and then after a while you move out and
Sure.
they move into, which is kind of like the accidental landlord. But this was purely an investment from the very get-go. So it was kind of my first.
Okay. And did you have a family at the time?
I did. I had my wife who's actually a real estate agent. So she'd kind of been in the business for a while. And throughout, wherever the military kind of put us, if we were in the States, it's kind of a job where, somebody can kind of just plug and play into a different location. You got to learn the areas and, you got to build that clientele in that local area, but you can easily transition that job. So it was kind of good for her.
Yeah, that's great.
Talking the same language.
Okay, cool. So you dipped your toe into the real estate investing world in 2005 in San Antonio with this, what you thought was going to be a duplex setup, ended up being a single family home, but ended up working out for you in the long run. And then you did a fix and flip and lent out some of your money. Was there any other investing that you pursued in that sort of 10-year time frame from 2005 to 2016 outside of the fix and flip?
Yes, there was a couple of single family properties that I bought while I was actually overseas. I was actually working in Mexico City, and this was around 2012 or 13 timeframe. So we had kind of gone through that the correction that we had, which was pretty tough on single family at the time, and the prices were just phenomenal. So it was just kind of you're looking at this and you're looking at how much it cost to build a property versus what they were selling these properties for. And it was just easy math. The hard part for me was being overseas and trying to work through being overseas and making an investment where basically we didn't have any connections other than whatever connections we make to acquire the property. So that was kind of the hard part. So we were able to buy 2 properties actually. And those are actually my only 2 single family properties that I have that I still have. And they're just fantastic because I bought them kind of at the bottom of the market. And these were brand new properties, newer properties that, they were built as the market corrected. And so it's just nice, 2 nice little properties to have. So I kept those. That, I guess you could say, is the first time I invested while being overseas, even though it was single family.
Yeah. And where were those located?
Those are in Florida, in the beautiful city of Port St. Lucie.
Okay.
On the eastern coast there.
And what would you say was the biggest challenge for you in buying those investment properties while you were overseas? Obviously, proximity is an issue, right? But anything else that really comes to mind that stands out to you?
Yeah, at the time, I had not really looked at trying to get other people to sort of help with these investments from a monetary standpoint. So it was basically whatever I could kind of come up on my own to buy them. And because they were pure investments, I did have to put 20% down on those properties. And so it was a little bit, difficult to sort of scale it. And if I, knowing what I know now, I mean, of course, different time frame, but having either a little bit more money or having some of the connections that I do now, we could have acquired 3 or 4 or 5 properties. I mean, you just couldn't go wrong at the time if you were looking in the right places. So just the money, I think, was the sort of the constraint.
Yeah. Okay. And just to give us some perspective, what'd you purchase those for roughly?
I'm sorry, how much?
Yeah.
So I bought a 3.2 for, it was just under $80,000. The property was built like in 2007.
Wow.
So built right when the market corrected. Yeah. And so it was pretty much brand new. And people were buying foreclosures and doing all kind of stuff at that time. And just about everything worked if you could just get the money, or figure out a way to kind of acquire those properties.
And did you have anybody guiding you as far as identifying any contractors or property management during that time when you acquired those?
No, actually I didn't. I mean, I reached out and I found an agent that I could work with that worked with investors. That's one thing that you can work with an agent, and if the agent's your standard agent, they're not going to want to deal with some of the, some of the back and forth that you do with investors. But if you find an agent that understands what investors are looking for and how an investor thinks, then you can build a decent relationship. And we did that. And we went through a couple where we were like, well, yeah, this is kind of what I wanted, but kind of zeroing in on exactly what we were looking for and got there. So I think that was the key, is just working through a few agents before we found the one that we liked that we were able to acquire these through.
Gotcha. So having that agent as sort of your boots on the ground was probably critical to the success of those 2 deals.
Yes.
Okay, great. All right, so let's fast forward a little bit. 2016 rolls around, and what's going on in your head that's got you starting to think about, moving into larger commercial multifamily?
Sure. I think the biggest thing is I was getting ready to go back overseas at the time. I was actually I had my single family properties, but I was actually using the money that I had, and I was focusing on hard money lending, basically giving my money to a hard money lender. And I was actually working at the Pentagon at the time, I remember, and I was basically getting about 10% on my money, but it was just a lot of give and go because of the fact that these properties are getting rehab 2-3 months, 4 or 5 months, and you got to put that money back in, and the money had to come back because it was through a self-directed IRA at the time, and so it just was a lot of churn, if you will, to kind of keep doing that. And when I knew I was going overseas, I wasn't going to be able to do it, so I started looking for something else that would work, longer term investments that were passive, and that was kind of the key, because if you're kind of in the States, you can kind of do some investing on your own time on the weekends as time permits. But when you're overseas, sometimes in a different time zone, you just don't have the time to deal with just about any issues. You're relying either on a property manager, or you're relying on someone to kind of handle all of your problems. And your spouse has got enough to deal with, right? With the kids, I had 2 boys that were growing, and so it was just another thing that I kind of didn't want to put on her. And so I was looking for really a passive investment, and the more I researched, the more I realized that being a limited partner in a syndication was a way to do that, because you have a property manager. On top of that, you have the syndication team that's acting as the asset manager for those properties. So really, all I had to worry about was making sure that the numbers were right. I zeroed in on my areas where I thought I wanted to invest before I actually looked at a syndicator team. And then once I found that, then I was comfortable that these investments were going to make sense. And actually, I started looking in 16. I didn't actually make an acquisition until 2017, while I was already overseas. But I had started the process, and when we were actively looking. It just took a while, again, because good deals are they're not falling out of trees. You got to go get them.
Yeah. For sure. So I think this will be a valuable conversation for us to dive into a little bit. I bet that we have a lot of listeners that are in a similar situation to yours, where maybe they're not in the military, but and overseas, but that adds some complexity to it. But maybe they're in a W-2 job working full time. They don't necessarily have the time, nor the energy, nor the wherewithal to go out and try to identify, good multifamily opportunities. But if they've listened to our podcast, they're probably familiar with the idea of passive investing. So let's, if you can, maybe walk us through that process. Like, what were the steps that you took at the beginning of 2016 when you started to think about this? And you mentioned, exploring different markets, exploring different syndicators, until you actually made your first investment in 2017 when you're overseas. What was that process like for you? What were the steps that you took to get yourself from, okay, I'm interested in apartment investing, I know I can't do this on my own, passive investing might be the right path, to actually making a passive investment in another syndication?
Sure. No, great question. I think for me, it was important, and this is kind of me as having an analytical background and having moved from one place to another so many times. I kind of got used to really doing the analysis myself. And I felt that, okay, if I want to do this, I want to make sure I'm picking areas. Now I'm no longer constrained by where I'm living. So now I want to pick the best areas of the country where it makes sense for me to invest, and I can get the greatest return on my investment. And so you start looking at key criteria, and you have to establish these. They're pretty simple, but if you don't go through this process, you could find yourself investing in areas where potentially the returns aren't quite as good. But you got to look at the demographics. You got to look at population. Is it growing? You definitely want a population that's been growing, at a healthy clip for at least 2 to 3 years. You want to look at a growing economy. They kind of go hand in hand, because when you have a good economy, you generally have more people that are coming into those areas for work. And then you want to look for areas that have some sort of a technical, something that's attracting a younger generation, if you will, of college students, of college graduates, something that's going to draw them, because that's really the next generation. You talk about the millennials already in their 30s, but they're starting to come along, and they're going to hit that point where they're now they're completely self-sustained, and they're going to be looking to do things in where they want to live and where they want to raise a family. So if you can kind of focus on those trends, those positive trends that make good investment decisions, you can zero in on your market. So I zeroed in about 4 or 5 markets that I was looking at. And once I did that, once I knew, okay, these are the areas I want to look, then I just had to find syndicators that were operating in these areas, that had potential acquisitions in these areas. And so that was a little bit harder than I expected, because I was looking at, I'm not an accredited investor. I'm pretty close at this point, but I'm still not. And so for those of you that may not know this, 506B is a syndication where you can bring in up to 35 what we call sophisticated investors, which is basically folks that are, they're not making $200,000 or more a year for the last 2 years, and they don't have basically a
net worth
over $1 million, and not including your personal home. And so based on that, these deals, they can't advertise those deals. That's kind of one of the regulations that the SEC kind of puts on these syndicators that are using the sophisticated investors as part of their capital raise. And so you have to go to them. You have to find find them where they're at, build some sort of trust, and then figure out of all the folks that are sort of doing this in that area, find out who you really trust. You got to vet them. You got to use some process, talk to some folks that have invested with them in the past, figure out how those investments are doing, and then you can kind of zero in on a syndicator that's looking in the areas that you're focused on. So once you've gotten to those two, then it's just a matter of waiting for an opportunity to come up with those syndicators, if you will, that you've chosen to do business with.
And so what was the process that you went through to identify the syndicators? Did you just research online and reach out to people directly? Did you send emails? Did you reach out on LinkedIn, social media? What was sort of the process you went through to connect with and vet a syndicator?
Sure. At the time, and I still am a member, I used Bigger Pockets as a networking tool to reach out and talk to other people that were investing or that were investors, and sort of start getting recommendations. So I basically said, hey, I'm looking to invest. These are the areas that I'm interested in investing. Is anyone investing in those areas that's willing to, is doing what I'm looking for, so that I can do a passive investment there. I got some folks sending me some potential info of general info, but it was still a process of connecting with the syndicators themselves. And so once you kind of get a couple of names and you start connecting with that network, things start trickling your way a little bit, and that's kind of how it started.
Gotcha. Okay. And then what was it about the deal or the syndicator, your very first deal in 2017? What was it about the particular deal or the syndicator that caused you to actually say, all right, this is the one that I want to move forward with?
Yeah. So on the deal itself, it was in the area that I wanted. It was a value add property. I'd done some research. I kind of had an idea. A value add deal is very much like a fix and flip or a rehab in a single family space. And I understood that concept. So I was looking for something that you could drive value, which is a lot easier to do on the commercial side, because it's based on your net operating income. It's not based on the comps of other properties in the area. But, so I was looking for a particular type of investment. And then as far as the syndicators, I started to listen to some of their podcasts. A lot of syndicators have some method of kind of, exposing themselves to the audience, and kind of letting, they have to have a way to show others, potential investors, that they're serious people, that they're, that they can be trusted with their money. And so you start kind of reviewing and talking to some folks. And in fact, I I had a chance before I went overseas to go to a multifamily investing conference. And I actually had a chance to talk to several syndicators there as well. I ended up going with one that I actually met in person.
Gotcha.
I felt comfortable with the way that they were as a person. I felt comfortable with their story, and I was able to get some very good recommendations from people that had invested with them in the past.
Oh, that's great. So that face-to-face actually had a pretty big impact, being able to see them and talk to them and connect with them personally face-to-face.
It did. And I actually, before I even met them in person, I had already seen some of their podcasts, so it made it a lot easier to sort of to feel like you connected with them. And so, but yeah, that definitely face-to-face is definitely the best way if you can get, but I would think, for me, I would have been comfortable if I had enough information on that individual and I had 3 or 4 folks that are actually still investing with that individual tell me, hey, this guy's the real deal, here's why, and that they're open with you, because that's not everybody wants to kind of expose, what they're doing, how much money, and, but when you're able to, first of all, get those names from the syndicator, say, hey, sure, I'll give you some people so you can see what we've been up to, give you the names, and then those people are willing to reach out and talk, in a way that was authentic about how enthusiastic they were about their investments. I think that's a key. That's important.
Yeah, that's great. Okay, cool. So take us forward from there. So you placed this first investment in this first syndication deal that you ever did. And how has your business evolved since then? You were still full-time military in 2017.
Absolutely.
So how has things evolved since then?
Yeah. So what the biggest thing is after I came back, so that investment kind of kept me kind of in the limited partner space. But my desire from the very get-go, even from before I did that deal, is that, when I actually do retire, I want to do this full time. And I already had decided it was going to be real estate. It was just what. And then the more I looked at it, the more I understood how how some of the tax benefits were better on the multifamily side through cost segregation and other things that kind of set them apart from single family investing. The more I was started to prepare myself for an eventual transition. And so when I came back, it was a 2-year assignment. I got back at the end of 2018. And at the end of 2018, I came back, and then I invested as a general partner in a deal in July of 2019. So I was studying, I was kind of preparing myself. And then as soon as I got back, I was able to start making some of those moves to get into a general partnership versus just a limited partnership. And so I was actually still active until, past that first deal that we did. So it's possible, even as a full-time person, if you really desire to do something different, if you don't like what you're doing, it is not impossible to make a transition into a general partnership and potentially transition to a full-time role in real estate investing.
Yeah. And what was the process that you went through to make that transition? You're still working full-time. You've made a limited partner investment in a syndication. What were the steps that you took to actually, cross onto the other side, onto the general partnership side?
Absolutely.
While you were still full-time?
Yes. I think that the biggest thing was really just the networking helped a lot. So I was willing to talk to as many people as possible about what I was doing and how I was transitioning. It helped that I was in a good market, Florida being a good market, and being here. A lot of people that are wanting to invest here, they were wanting to discuss it with me. And then just from going to some of the networking events and meeting people face to face, you meet other syndicators that are in the space that when they find a deal, especially if they're not, a senior syndicator deal, but somebody sort of starting out, somebody that doesn't quite have all of their team members that they need for a particular deal, or if it's a bigger deal, they need more team members. And so I was able to discuss with several and say, look, I want to invest. I had some money to invest after the time that I saved some money, and I had some single family properties that I was divesting out of, and I had some cash. And I said, look, I want to be on a general partnership side. Here's what I can offer. I can offer time. I can, some time. I'll be able to offer you a lot more time once I retire. But for now, I can offer you some time and some money into this deal. But I want to be on the general partnership side. And oh, by the way, I can help raise some money as well to bring to this deal. So in my case, that's the way I did it. Other people, maybe they have more time, or maybe they have some other value that they can add to that syndicator group. Maybe they're good at underwriting properties. They just have a very analytical mind. There are different things that you can kind of present to a group that is looking for to grow, and say, here's what I can add. And you just have to talk to enough people, and eventually you'll find someone that's willing to take you on.
Yeah, that's great. Great advice. Thank you for going into that. Well, and then, so that was your first general partnership syndication. Okay. And then you've done a handful since then. Talk to us about how things evolved since that first syndication as a general partner.
Sure. So that was, so we closed on that one in July of last year. And so once you close on a property, the next thing you're doing is looking for the next. And so you want to have some momentum along the way. Of course, I was actually beginning my transition out of the military, so it kind of took up some of my time where I was not able to kind of really focus in, dig in, and kind of transition into a deal that would faster. I've learned through my time in doing this what I like to do the most in the multifamily space. I really enjoy talking to people. I enjoy helping others that are trying to make this transition, or just talking to folks that are potentially looking to invest and they just have questions. So I enjoy that aspect. So to me, that face-to-face, or whether it's face-to-face or whether it's a Zoom call or some sort of video teleconferencing or a phone call where you're talking to people and you're helping them out, to me is extremely personally satisfying. And so that really bodes well with, especially where my background is of, how I kind of came up through the ranks, if you will, of investing to help others look at it from that same prism. Okay, so maybe if I start as a limited partner, I can kind of work my way. And I've been able to talk to others and raise some capital for others that are willing to get into this. And to me, it's not about selling it. I mean, I'm personally I'm putting my own money into it because it pays off. It's not a hard sell where you're selling some widget or something. Like, look, you either want to do it or you don't. I mean, there are other things you can do with your money. Maybe you just want to diversify, but it's working for me. And that's kind of what I tell people. And some of them are interested and some of them are not. But you just have to talk to folks, and it's really easy when you like helping, as opposed to just trying to get something from folks.
So would you say that that's become more of your focus, is educating others about apartment investing and raising capital for other syndication deals?
Yes.
Is that sort of your part of the business that you like to focus on?
Absolutely. And so to me, it was kind of like, okay, what I can bring to the table is being able to bring others that potentially are willing to invest, and showing others the ropes to get them going along the path. And so it was to me, it's an easy transition. I can do the other things. I wanted to make sure, as a military officer, they teach you pretty quickly early on in your career, like, you really have to understand, at least at the general level, what the folks that you're leading are doing. So if you're leading an organization and you have certain core functions, you have to understand how those core functions work and how to do it at any point in time. So I understand the underwriting aspect of deals. I know how to underwrite. I learned how to do that by taking courses and actually working with others. I deal with brokers. I talk to brokers because if an opportunity comes up, I'm not going to turn away from it. But I think where I bring the most value is partnering with others that have those relationships potentially a little bit tighter, and they really enjoy more of the underwriting, analyzing of the deal versus actually, the capital and the marketing side. Yeah.
And would you say that your experience in the military and the network that you've built in the military has been a big part of the investors that you've brought into a syndication?
I would say it hasn't been a big part. It's been a part of it. I've actually had some folks that I've worked with do that, but it hasn't been a huge part. In fact, it's more about learning how to get out on social media, which was, to me, was completely interesting because as a military officer in my background in the military, we didn't get on social media really. People got on social media when they were retiring, right? And it was like, I'm going to go back and I need to expose myself. But for me, it was a hard transition from not doing anything to basically exposing myself and my my family to some extent, and a lot of my personal information, just because to be able to attract others that are looking for this kind of investment opportunity.
Yeah.
That's great. It's done a lot more than just people that I've known before.
Gotcha. Okay, great. Well, man, Ray, thank you for going into detail about this process and your journey that you've taken to get into multifamily investing. I want to dive into our deal dig segment where we just talk about a particular deal. This 57 unit Class C deal that you did. Do you mind just sort of walking us through, I believe it was in Memphis, Tennessee, if I'm not mistaken. Maybe just describe the asset itself to us, just so that we have an understanding.
Sure. It was a C asset, a C class, which is basically an older asset. This property had actually been gutted by the previous owner, vacated completely, and he'd done a large portion of what we would consider the value add. So a lot of the exteriors were done. A lot of the units themselves had already been remodeled to some level. There was still what we consider some meat on the bones for some minor upgrades and some branding and some other things to do to that property, but it wasn't a heavy duty. It was almost more of a stabilization deal. But what made it interesting is that the property at the time, because he went from basically zero occupancy and he was working his way to getting the occupancy that he needed, which is 90%, he wasn't able to quite get there in the time that he needed to sell. So we had to the syndicators actually had to use a bridge loan, a bridge strategy to take it from that bridge loan into a agency debt through Fannie Mae. And so so we were able to, they were able to write out that difference, get it up to 90%, and then refinance that property. We got roughly 50% of our money back, which was kind of nice when they refinanced it. And now it's basically, it's performing at about 96% occupancy. And so it's meeting all of the criteria. So Memphis is still an expansion market. If you go in there, Integra and some of the other, companies that actually look at, where the major MSAs are, you'll see that Memphis is still solid expansion. And so we like our opportunity there to basically hold on to it for another year to 2 years and sell it at that point. And so at a strong price. And so I like our how that's looking right now. But the complication was getting from that bridge to that Fannie, because if you don't get the occupancy that you need, you're basically going to have to extend on that bridge loan, and that extension was going to cost you a little bit on the interest, because that's kind of how that loan worked. And
so if I understand you correctly, you had another syndicator or owner who bought this property with the intention of doing a deep value add. They gutted the entire thing, took it down to 0% occupancy, rehabbed the entire thing, and were working on building it back up. But they had a loan that was about to be called due, and they couldn't get it, and they hadn't been able to get it to 90% occupancy to be able to get agency debt, to refinance into agency debt. Is that correct? Is that what you were saying?
I believe that's what it was. Either that, or they were just looking to get into something bigger. I mean, some
Gotcha.
value add folks, they like to, they understand that if they don't leave any meat on the bone, it's going to be tough to bring in an investor group to take it on, when all you're going to do is basically keep the property where it is. So you're already selling at a high price point because of the NOI, and you're not going to be able to do much more to it. So it's kind of a strategy to just kind of leave something there.
Yeah.
I think I'd like to have gotten it to 90%, but I think timing was an issue for him.
Okay. And so do you remember what the occupancy was when you guys acquired it?
It was at 86%. So it wasn't that bad. It was close, but it just wasn't there. So we ended up having to do the bridge, which is part of why we got a good deal for it.
Yeah. Okay. So you go in while it's at 86, and you acquire it with a bridge loan. and then your goal was just go in and really just do a light value add at that point. Most of it's already been done. Is that correct? Was there anything that you guys needed to do when you took it over?
No, I mean, it was pretty much, so that he'd done a lot of work on the interior. So we actually had a little bit to do to clean up on the exteriors, landscaping, some minor painting on the exterior. The roofs were taken care of. So it was really just kind of put the finishing touches on there and start working through, the occupancy. Now, one of the things that is always good to check when you're doing these things is how long has a property, you got to take a look at those leases. And so some of those leases, were already month to month, even though it was at 88% occupancy or so. Some of those folks are already at the, they could leave at any time. So it actually took a little bit of a dip from the time we acquired it. It went down a little bit. I think it went down to the low 80s, and then it started trending back up as we started getting long-term tenants in the property.
Gotcha. So really it came down to just less about any capital improvements and more about operational efficiencies and working on getting that the occupancy up.
Correct. Absolutely.
Okay. And then what happened with it from there? What was the process? You had the bridge loan. Are you still in the bridge loan, or are you still working into agency debt, or what?
No, we actually got out of the bridge loan. It took a little bit longer than a year to do the bridge. So we had to get to the extension, which was one of the things you want to do when you do bridge loans. You want to make sure that you have some tail if you need it. So, but it's out of the bridge loan. It's on straight agency debt right now. And we were able to get 50% of our investment out of the deal. So it was kind of nice. You put in some money, you get half of your money back, and now you're still getting the returns from it. So it's very nice. So at this point, it's sitting at year 2, really, of a new agency debt on that property. And it's just cash flowing nicely.
What's your occupancy now?
It's at 96%.
Great.
Yeah. So
excellent.
It's pretty good.
Yeah, that's a great deal. Cool. Well, thank you for walking us through that. I guess the last question I would have on that is, since the key factor was improving occupancy, you did talk about the leases a little bit, but I'm curious if there was anything in particular that you guys had to do, or any challenges that you faced in getting that occupancy up above 90%.
I think the initial thing is, as you're basically trying to raise the occupancy, you also want to kind of look at the rents, right, and the cost, the price per rent. And so so you had a combination of month-to-month folks that were at lower rents, and so you're looking at raising rents across a timeline. But at the same time, more importantly, you definitely want to get out of that bridge. So it's that combination of those two, and how much, sort of that's kind of the art of the deal, is how do you raise rents to what is basically market rents at that point, but still continue to uptrend that occupancy. And so it required some gentle management and some steering to get it to where it needed to get. And obviously it took a little bit longer than a year. We expected it to be less than a year. So it just took a little while to be able to, basically go from an 86 down to almost 80. And then at the same time, trying to raise rents a little bit, because you can rent it, you can occupy the place, but if you're not going to hit your numbers, then that's not going to be any good either.
And so I assume, well, I don't want to assume, did you leave the existing management in place, or did you bring new management in when you took it over?
Brought in new management. Yeah.
And I assume then that was critical. And it was the management company, is the management company someone that you had worked with in the past and had built a relationship with, or was it brand new as well?
And this one is, I was a limited partner, but my understanding on this one, it was a property management company that was in the area, but it was new. The syndicators were new to that market as well.
Gotcha.
It was a new property manager.
Okay, great. All right. Well, Ray, thanks for diving into some detail on that one. It sounds like a great deal, being able to, in 2 years, pull out 50% of the equity in that deal and return it to your investors. I'm sure they were happy about that. And now you're sitting at 95% occupancy, and it sounds like it's moving forward the way it should. Well, Ray, I appreciate your time. I want to start winding down here. I've got a final few questions for you. The first one is, What's the biggest challenge that you've faced in your apartment investing journey so far?
I think the biggest challenge right now, and it's not just me, it's actually finding deals. I mean, right now, there are a lot of people just selling stuff that are just, you're just wondering how they're coming up with these numbers. And I know brokers are always looking to maximize a sell. They're obviously representing the sellers, but some of them are just really, really, like, you just look at them and going, well, how is this even possible? But you're starting to see a lot of, especially in this area of Florida, there is a lot of foreign money that is being used to buy some of these properties, and foreign investors aren't looking for big returns. I mean, they're really just happy not losing their money from wherever country they're investing from, and so it's hard to sometimes compete with those institutional buyers, because these foreign investors are going to institutions and investing with them, and so it's really driving up the prices. Cap rates are reduced, so when you're talking about, a group of investors that are trying to get 8 to 9% cash on cash, 15 to 17% IRR, it's hard to compete with these foreign investors that are basically 4%.
Yeah, that is a challenge for sure. What's the biggest win you've had on your apartment investing journey so far?
I think the biggest win was when I was able to make that transition from, in that first, while I was still on active duty, and make that transition, because it really I felt comfortable that I was going to be able to do this. If I was able to do it while I was still working, there's no way that I was going to fail, while I'm doing this full time. And so it was just a kind of, it was just an indicator to me that I was on the right path, and it worked out. And so far it's going great. It's just a matter of finding the deals. One of the things that I've done, and a lot of people are actually doing, is partnering up a lot more. So if there are less deals that make sense, there may be bigger deals. Then the only way that you can take those down is to partner with other people and bring the best of both worlds. What is it that you're doing that you can bring to that bigger team to take down some of these assets that are, frankly, you're competing with institutional buyers at that point. So that ability to combine, maybe having some flexibility, is something that we're looking at now. Is how do we continue to acquire the right deals?
Yeah, that's great. All right, and then the last question for you: what's the best advice you have for someone who's just starting their apartment investing journey?
Yeah, I think that the biggest thing is education. If you really want to do this, you're gonna do it on your off time, on weekends. You're gonna find a way to learn some of the things that you need to learn. And then once you've kind of gotten through that initial point of, okay, I know a little something, then you really have to make an effort to connect with others that maybe have a little bit more experience or a lot more experience, and talk to them and ask them. The people like me that really just enjoy it, get on a call. I get on calls with people all the time, and I give them my calendar, and they plug and play, and we talk about it. What are your questions? And so start educating yourself, start showing others that you're motivated and you're on your journey, as opposed to just kicking a tire. Because that's where I think, some people, at least some investors, if they're really busy, you kind of wonder how much they're going to be willing to invest in a person that really is not sure what they're doing. So if you're interested, you're gonna go out there and you're gonna do your own, sort of self-discovery to some extent. And then obviously before you start investing, you want to kind of zero that in with some additional help. And there are plenty of people out there, plenty of articles, plenty of places you can go to kind of invest more in your knowledge base.
Yeah, love it. All right, Ray. Well, thanks for your time today. I really appreciate it. How can people learn more about you and the deals that you have coming down the pipe? And if they just want to connect and see what's going on in your world, what's the best way for them to reach out to you?
Best way is just go to my website where all my information is at. It's www.mirealestate.us. mirealestate.us. And you can connect from there to all of my social media feeds and some of the articles that I've published.
Awesome. Well, Ray, thanks for taking the time. I appreciate you sharing your story with us. It's pretty cool how you were able to, start your investing journey back in 2005 on that San Antonio deal that you thought was going to be a duplex, ended up being a single unit, but you made it work. And really how you've made this cool transition into multifamily, large commercial multifamily syndication. while you were working full-time in the military and ultimately making the full transition out, retired from the military now going full steam ahead on your real estate investing business. And so congratulations and thanks for sharing your journey with us. I appreciate it.
Thank you for letting me get on and talk, and good luck to you, and hope to be able to touch base with you again. Thank you.
Well, we'll do. Okay. Thanks, Ray. Bye-bye.
Bye-bye.